Opendoor Technologies is currently trading at exactly $7.78 USD, showing a slight intraday push of positive 0.040 points, or roughly 0.52% in today's session. If you were looking at that green number on your screen and thinking this is the start of a straightforward recovery story, you are missing the far more complex and, frankly, more dangerous game being played beneath the surface. The expectation right now, the one fueling the chat rooms and the retail forums, is that Opendoor has survived the winter. The narrative is that with the Federal Reserve finally cutting rates in 2024 and 2025, the housing market is unlocking, and Opendoor, as the last major iBuyer left standing, is about to print cash like it's 2021 again. That is the expectation. The reality is remarkably different. The reality is that Opendoor isn't recovering. It is mutating. The company you are buying today at $7.78 is fundamentally not the same business that traded at $30 years ago. And if you are betting solely on a housing market bounce, you might be betting on the wrong catalyst entirely. Let's look at the price action because the chart tells a story of violent redistribution. We have seen this stock claw its way back from the absolute brink, trading as low as 51 cents just last year, to hovering near $8. That is not normal market behavior. That is a repricing event. When you see a stock move over 1,000% from its lows, while its revenue, and we will get to the earnings in a minute, is actually down, you have to ask yourself, who is buying? We are seeing massive volume spikes that look less like fundamental accumulation and more like the speculative fervor we often see with Tesla stock during its most volatile periods. The difference here is that Tesla had cars rolling off the line. Opendoor, in this recent run-up, has shrinking revenue. This disconnect between the stock price exploding and the business shrinking is the single most critical tension you need to understand. It suggests that the market is pricing in a future that doesn't exist yet, effectively paying a premium for a maybe. The common ground we all share is the understanding that the housing market has been frozen. We all know that mortgage rates locked up inventory. The general belief is that as rates come down, volume goes up and Opendoor wins. But here's the contrarian take that should force you to rethink your position. Opendoor doesn't want to be a house flipper anymore. Under the new leadership of Kaz Nejatian, the former Shopify executive, the company is aggressively pivoting away from the capital-heavy model of owning thousands of homes. They're trying to become a platform, a software layer for real estate. This is why the stock is up. It's not because they sold more houses last quarter. They actually sold significantly fewer. It's because the market is starting to value them like a tech company rather than a heavy asset real estate portfolio. But here's the risk. They haven't proven they can actually be a tech company yet. You are paying a tech multiple for a company that still largely makes its money moving physical drywall and concrete. When we look at the intraday movement today, that 0.52% gain is fighting against a broader sector heaviness. We're seeing volume heavily concentrated in the opening hours, which often indicates retail traders executing orders placed overnight on platforms like Robinhood or SoFi Invest. The institutional flows, however, tell a darker story. While we have seen headlines about Jane Street taking a position, which gave the stock a massive legitimacy boost, we need to look at what the smart money is actually doing with that position. Often, firms like Interactive Brokers see heavy hedging activity around these levels. A lot of that institutional buying might be paired with sold calls, effectively betting that the upside is capped. If you were sitting there with your Schwab Intelligent portfolios or managing your own individual brokerage account, you might see the Jane Street news and think, all clear. But sophisticated hedging suggests that the big players are protecting themselves against a rug pull. Let's talk about the macro environment because it is crushing the unit economics of the old business model. Even though the Fed cut rates, mortgage rates haven't followed them down in a straight line. They're sticky. They are tethered to the 10-year Treasury, which remains stubborn due to long-term inflation fears and fiscal deficits. This means the refinance boom, or the move-up buyer wave that everyone expected to save Opendoor, hasn't fully materialized. The inventory is tight, yes, but affordability is still near historic lows. For a company like Opendoor, this is a double-edged sword. On one hand, tight inventory keeps home prices high, which protects the value of the homes they do own. But on the other hand, their business model relies on velocity. They need to turn capital over. If houses sit for 120 days instead of 60 days, their internal rate of return collapses. This is why the revenue numbers from Q3 of 2025 were so stark. $915 million. That sounds like a lot until you realize it's down by 30% from the previous year. They are shrinking the business to stop the bleeding. This brings us to the operational reality. The company recently distributed tradable warrants to shareholders. This was a fascinating, rare move. It was essentially a signal from management saying, "We know the stock price has been beaten down, so here's a levered bet on our future recovery." It got the retail crowd on Robinhood stock trading forums incredibly excited because it feels like free money. But warrants are dilutive if exercised. They create an overhang. If the stock rallies hard, those warrants get converted into shares, flooding the market with more supply. It's a clever financial engineering tactic to keep investors engaged without spending cash they desperately need to preserve. But it also adds a layer of complexity to the valuation. If you were using Fidelity Investments or checking your Fidelity mobile app, you might have seen these warrants appear in your account and wondered what to do with them. They are a bet on volatility, nothing more. We need to discuss the shopification of Opendoor, because this is the core thesis for the bulls. The new CEO wants to build Opendoor exclusives and use AI to price homes instantly, connecting buyers and sellers directly without Opendoor ever taking ownership of the deed. If, and this is a massive if, they can pull this off, their margins change overnight. They go from making a razor-thin 4 to 5% gross margin on flipping a house, risking hundreds of thousands of dollars of capital, to making a fee for a software transaction with almost zero risk. This is the Apple stock transition moment they are aiming for, moving from hardware, houses, to services, software. But right now, this is largely unproven. The revenue from these new initiatives is a drop in the bucket compared to the legacy flipping business. So when you buy Open at $7.78, you're effectively acting as a venture capitalist funding a seed-stage software startup that happens to be attached to a large, struggling real estate flipper. Let's take a pause on the analysis for a second because I want to hear from you. This stock is one of the most polarizing names in the market right now. Comment below with your average cost basis on Opendoor. Are you one of the OGs holding from the $20 SPAC days? Or did you catch the falling knife at $1? I'm genuinely curious to see where the support levels are for the people watching this. Back to the analysis. We have to look at the competitors because Opendoor is essentially the last gladiator in the arena. Zillow exited iBuying. Redfin exited iBuying. They looked at the math, looked at the volatility of the housing market, and said, "This is a bad business, we are out." They went back to being media and lead generation companies. Opendoor stayed there. For a long time, the market punished them for that, treating them like the bag holder of the industry. But now there is a counter-argument emerging. Being the only liquidity provider in a fragmented market is a monopoly position. If, again, the big if, the market normalizes, Opendoor has no competition at scale. They have the data, the algorithms, and the infrastructure that no one else wanted to maintain. This could be a winner-take-all scenario, but the cost of winning is massive cash burn. Financial health is the elephant in the room. In Q3 of 2025, they posted a net loss of $90 million. They are burning cash. While they have a runway, it is not infinite. This is why you see them on investing sites and brokerage feeds like SoFi or E-Trade, often tagged with high volatility warnings. They are racing against time. They need the software pivot to start generating high-margin revenue before their cash pile from the legacy business dwindles too low. This is why the stock behaves so erratically. Every piece of news, a slight change in CPI, a comment from a Fed governor, a shift in weekly mortgage applications, is extrapolated to mean life or death for the company. It's a high beta stock, meaning it moves with the market but at 3 or 4 times the intensity. If the S&P 500 sneezes, Opendoor catches a cold. If the Nasdaq rallies, Opendoor goes parabolic. Let's look at the psychology of the home seller in late 2025. This is a factor that algorithms often miss. Homeowners are sitting on record amounts of equity, but they feel poor because of inflation. They are reluctant to sell because they don't want to trade a 3% mortgage for a 6.5% mortgage. This lock-in effect is the biggest headwinds for Opendoor. Opendoor makes money on transactions. They need movement. A stagnant